Hi, I am Anna. I come from www.ntvforex.com. US-China tensions are rearing their head again. Analysis http ntvforex.com News ID AF114448132027 56:43 AM US stocks rallied to close near its all-time highs yesterday amid what some are saying are signs of greater confidence in the economic recovery in the US. Or perhaps EDA's just even speedier decoupling between Wall St and Main St. Nevertheless, bond yields pushed higher amid a faster-than-expected rise in U.S. inflation, whilst the market is starting to focus again on trade and tariffs. The fact that the broad stock market is at all-time highs is a testament to unbelievable amounts of monetary and fiscal stimulus. The patient is hooked, and only more drugs will do. The disconnect between the stock market and the real economy is too stark, too unjust, and too indicative of a system that continues to favor capital over labor that, sooner or later, a change is gonna come. Never mind all that for now though, stonks keep going up. The S&P 500 rose 1.4% to end at 3,380, just 6 points under its record closing high at 3,386.15, with the record intraday peak at 3,393.52. Asian stocks broadly followed through, with shares in Tokyo up almost 2%. European stocks failed to take the cue and were a little soft on the open, with the FTSE 100 the laggard at 1%, though 22.3 PTS are due to BP, Shell, Diageo, AstraZeneca, GSK, and Legal Amp General among others going ex-dividend. For a taste of the real economy, we can look at TUI, which said group revenues in the June quarter were down 98% to A75M. It's a total wipeout of earnings, but EDA's not a surprise. The business was at a virtual standstill for most of the period and was only able to resume some limited operations from mid-May. Just 15% of hotels reopened in the quarter, whilst all 3 cruise lines remain suspended. TUI posted an EBIT loss of A1.1 bn for the quarter, taking total losses over the last 9 months to A2 bn, with a 1.3 bn due to the pandemic forcing the business to be suspended. Summer bookings are down over 80%, but it has got another A1.2 bn lifeline from the German government. Shares fell over 6% in early trade. US-China tensions are rearing their head again. Officials meet this Saturday to review progress of the Phase 1 deal. White House economic advisor Larry Kudlow: the deal was a fine right now. Sticking with trade, the US is maintaining 15% tariffs on Airbus aircraft and 25% tariffs on an array of European goods, including food and wine, despite moves by the EU to end the trade dispute. Crucially, it did not follow through with a threat to hike tariffs. However, it still leaves the risk of further escalation when the EU is likely to win WTO approval to strike back with its own tariffs. Yesterday, despite the optimism in the market, there was, for me at least, some potential signs of bad news for the real economy, not the stock market. Remember, with US inflation picking up faster than expected. You can read this as the economy doing better than feared as consumers return, but you can equally take a glass half empty view and see this as a major worry that prices of essentials are going to rise whilst economic growth stagnates, which can be a cocktail for a period of stagflation. Given the enormous amount of money being pumped into the system, there is a better than evens chance we get an inflation surge, even if the pandemic was initially very disinflationary. Unlike in the wake of the financial crisis, the cash is not being gobbled up in the banking system as increased capital buffers etc., but is going into the real economy. Moreover, EDA's being done in tandem with a massive fiscal loosening. Year over year, headline inflation rose from 0.6% to 1%, whilst core CPI was up 1.6% in July vs the 1.2% expected. Food prices rose 4.6%, whilst the cost of a suit is down a lot. The risk is that inflation expectations can start to become unanchored as they did in the 1970s when the Fed had lost credibility. This led to a period of stagflation and was only tamed by Volcker's aggressive hiking cycle. Investor optimism is keeping the dollar in check. The dollar index moved back to the 93 mark, whilst the euro broke above 1.18 against the greenback for a fresh assault on January 19, twice rejected lately. Sterling is making more steady progress but is well supported for now above 1.30, however the dollar's pullback may be short-lived. Gold held onto gains to trade above $1,930 after testing the near-term trend support around $1,865 yesterday. Oil prices held gains after bullish inventory data and OPEC's latest monthly report. WTI SEP moved beyond $42 after the latest EIA report showed a draw of 4.5 M barrels last week. Meanwhile, as noted yesterday, OPEC's new report indicated the cartel will continue with production cuts for longer. In its monthly report, OPEC lowered its 2020 world oil demand forecast, forecasting a drop of 9.06 mbpd compared to a drop of 8.95 mbpd in the previous monthly report. But the report also sought to calm fears that OPEC will be too quick to ramp up production again. Specifically, OPEC said its H2 2020 outlook points to the need for continued efforts to support market rebalancing. Compliance was down, but broadly the message seems to be that OPEC is not about to walk away from the market. Subscribe our channel to receive the news as soon as possible. Thank you for watching. If you want to read real-time news, text messages to MT5 Expert Advisors page at https://mt5.expert.advisors.